For today's video, I thought I'd quickly go through the ways in which I select dividend stocks. There's been a number of viewers on the channel wondering what are some of the criteria that I use for selecting dividend stocks. I thought I'd go through those very quickly, a couple of very broad criteria that I use, and then some more specifics about the particular dividend company and the dividend that it's giving out. Is it sustainable? Is it reliable? And can you set the stock on autopilot, come back in 50 years and see that it is still performing just as when you bought it? So let's go through very quickly these criteria. I thought as an example, I would use Coca-Cola, KO. This is a company that does not get a lot of attention. This is not Netflix, Google, and Amazon, one of the FANG stocks. This is a very boring stock, but a stock that's been around for quite some time, an entrenched company, durable competitive advantage against a lot of its competitors. Yes, it is going through somewhat of a transitionary period from soft drinks to healthier options, energy drinks, water, so on and so forth. But this is a very reliable company that is a quintessential dividend stock that you can essentially buy, put on autopilot, check your brokerage account in 50 years and see that you have reliable income over the longer term. So let's go through two very broad criteria first, in which any investor should take a look at for a dividend stock. First, the company should have the ability to provide a reliable, consistent dividend over time with a reasonable yield. So essentially, like I said, you can buy the stock, put it on autopilot. Every quarter, you'll have reliable dividend income, which hopefully over time will increase. And that's sort of the second criteria, is that you want a dividend that increases over time to outpace inflation, as well as some moderate growth with the company as well. Again, these aren't going to be stocks like Amazon that in 10 years will be up 1,000, 2,000%. These companies will simply outpace inflation, but providing a very reliable and consistent source of income every year in the form of a dividend. So let's kind of dive in a little bit deeper now. After going through those two very broad criteria, what are some of the criteria about the dividend? Well, you want a very good dividend yield, a reasonable dividend yield, maybe the top 10 to 20% of companies that produce dividends, anywhere from 3 to 6%. Take a look at Coca-Cola here. You can see in the statistics part, dividend yield is 3.226, so right at the bottom of where you'd want a dividend yield for the longer term. You also want a consistent, reliable dividend as well. And Coca-Cola is one of the dividend kings, a company that has produced a dividend for 50 plus years, but not only produced a dividend for 50 plus years, but has also increased that dividend as well. Take a look at some of the dividend payments I've received in the portfolio. First got into the stock in 2016. Let's take a look at the dividend, October 3rd, 2016. You can see at that point, the dividend was 0.35 per share. In 2017, the dividend increased to 0.37 per share. And in 2018, the last dividend payment, it increased to 0.39. And this company has been doing that for 56 consecutive years. So one of the dividend kings. You'll also hear of dividend aristocrats and dividend champions. Those are companies that have 25 plus years of reliable dividends, but not only reliable dividends, but dividends that have increased over 25 years as well. And the different lists are just because the dividend aristocrats is composed by the S&P 500, or at least the S&P committee, and the dividend champions are composed of a different group, the DRIP Investing Resource Center. So they both have 25 plus years, but dividend kings have 50 plus years of increasing dividends over time. So that is the second criteria. The third one, kind of in the same lines, would be dividend growth. Is the company able to increase that dividend? And as I discussed, dividend kings and dividend aristocrats and champions are able to do that. Next thing to take a look at would be the dividend payout ratio. Essentially, it is adding up a year's worth of earnings per share, as you can see here, dividing that by the total dividend payment. Typically, you'd want a company around 40% or so, all the way up to 80%. Coca-Cola is right in that 70 to 80% range, so up on the upper limit of what a reliable dividend would be. If you get over that, the company has somewhat of a difficulty paying out the dividend. Essentially, it's paying out all of the income that's generating to the dividend investor in the form of a dividend. So if the company's payout ratio is too high, the company over time may have some difficulties, especially in transitionary periods in which Coca-Cola is, in paying out a dividend. And the last dividend payout ratio for Coca-Cola was 140%. Like I said, it has been going through some transition, but before that, it was a very reliable 60 to 70% payout ratio, which is very good and very sustainable over the longer term. And then also, you want a dividend that is going to increase by having increasing future earnings. So you want to take a look at the earnings per share and kind of see if that's been increasing over time. Companies that have been able to push that up will also have a much more reliable dividend, just because, as I said, dividend is essentially a proportion of the company's earnings given back to the investor as a dividend payment, as a cash payment. So those are the criteria. Again, the very two broad criteria are very generically the ability to provide a reliable, consistent dividend with a reasonable yield over the longer term, as well as providing some modest growth to the price of the stock to outpace inflation over time. And then breaking on the dividend, you want a good dividend yield around 3 to 6%, a consistent, reliable dividend, such as a Dividend King, providing 50 plus years of dividend growth, or a Dividend Aristocrat or Champion, providing 25 years consecutively of dividend growth. You also want the growth to be somewhat sustainable over time. Again, Dividend Champions and Dividend Aristocrats and Dividend Kings are the perfect examples of that. You also want the payout ratio to be anywhere from 40 to 80%. The lower, probably the better over the longer term, but if there's a strong company, having a little bit higher payout ratio is fine. And just one caveat to mention as well, real estate investment trusts, for example, by law are required to pay out 90+% of their income as dividends. And some of the telecommunication companies like AT&T, those typically have a very high payout ratio as well, but very normal for that particular market segment. And also, you want to focus on projected earnings growth as well. Companies that are having modest growth with regards to earnings will also have modest growth in their dividend, as well as sustaining that dividend over the long term in a very reliable fashion. So those are some of the very broad criteria I use in selecting dividend stocks. There are a number of other metrics you can take a look at as well. How much debt a company has, what particular pressures are the company going to face moving forward, like Coca-Cola, for example, was transitioning from soft drinks to healthier options, energy drinks. Lots of changes in the company, but a very good company, a blue chip company that has survived these types of transitions in the past will most likely survive these moving forward. So another thing to take into consideration when jumping into dividend stocks. So again, dividend stocks, income stocks are more about reliable, stable income over time, but you can essentially buy these stocks, put them on autopilot, and over the longer term have very reliable dividend income in your portfolio. So just quickly wanted to go through those criteria. I know there's a number of viewers on the channel wanting to know some of the very broad criteria I use. It does get a little bit more complicated once you start selecting down companies that meet all of those criteria, but for the most part, if you stick to those criteria, you can at least have initial starting list of very good quality companies to potentially add to your portfolio. So just wanted to talk about that again in response to a number of viewers on the channel. If you guys have any questions about this video, anything that I brought up you want expanded on, please let me know and I'll do an updated video focusing on those questions. So not to make the video too long, I'll kind of end it here. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. And until next video, we'll see you then.